certainly could. If the Dow gets above 17,800, I will say that I already don't know where it's going to go for sure, but I really won't know where it's going to go if it gets above 17,800. So that's basically what I'm looking at. The Apple position that I'm looking at, we happen to be in a short call, long put position that's actually not hurting very much, which totally surprises the heck out of me. But that's neither here nor there, and it could hurt you a little later in the day. So we'll have to wait and see, what happens, with that particular thing. What I'd like to show you on this cattle chart, if you'll take a minute, because we're going to discuss it when Rich Anderson comes on. But I wanted to show you the failure pattern. But since October, all during October and November, we've lost 50% of the open interest in cattle. In other words, the longs and shorts are leaving. And when this happens, when you have open interest dropping and prices going higher, that is caused by buyers, the shorts getting out of the market. And once that's finished, the market has a vacuum under it, and look out below. This is what happened to gold and silver a year and a half, I think it was 2 years ago. Yeah, 2 years ago, in April of 2012, when silver was $49, I believe. What happened was the open interest was dropping. We kept bringing that to everyone's attention. The same thing was happening in gold, and now we're having the same thing happening in cattle. This pattern that we have in cattle right now is a 3-drive pattern. It's also going to be a butterfly pattern when we get up to the 175 level. Folks, when I say 175, that literally blows my mind, because when I was at Drexel Burnham trading cattle, and we trade limit positions. We had a limit at that time was 600 contracts, and we did 600 routinely every day. And when cattle got to 75 cents, the housewives of America were on strike, complaining about the high price of beef. Now we're trading at 175, and there's not anybody out in the streets. I think they're all going to be in Ferguson, Missouri, when this verdict comes out, because if this police officer gets acquitted, there's probably going to be all heck to pay with people being, very, very angry, like they did with Rodney King in Los Angeles with the riots that we had, back in Los Angeles at that time. I was living there at that time, and that was not a fun place to be when that was going on. It all turned out okay over a long period of time, but, that doesn't mean it will work out this time. We'll have to wait and see what the future brings us. Okay, now let's move on to the gold market. The gold market is really trying to make a bottom. Yesterday, let me put up that chart here just a second, and I wanted to show you the action from yesterday because it was quite interesting. And I'll get it up here in a second, and we'll be able to see it. We had the referendum come in from Switzerland, or at least supposedly. I don't know if the jury's still out on that, but the rumor was that they were going to not pass the gold referendum, where the banks had to hold the gold. And so gold dropped about $25, and not more than an hour later, it was back near the highs, and then it backed off again, and it went right back up to the highs again. That's telling us that it's not just about this Greek referendum. That's the main thing to look at. We have a question about Japan, and I was going to go into that if I had the time, and I think I'm going to do that because I think it's really interesting what's happening here with the yen and the Nikkei, because that has a correlation. I'm going to put this up to show this because there's a chance that the yen did reverse. Let me show you the long-term pattern that I'm looking at here with this Nikkei. And if I can get it in here, you'll be able to see it. We have a 3-drive pattern going on here in the Nikkei. And as you can see, this thing topped 4 weeks ago and hasn't gone any higher than the 17,500. And I think it closed around 17,200 and change or something yesterday. But the important part here is if you look at what the Japanese yen currency did versus the Nikkei Dow, and this has a correlation of over 90%. In other words, when the yen goes down, the Nikkei goes up. I don't know what that correlation means, but that's what's been happening. But over the last 10 days, the currency has accelerated much more rapidly than the stock market for Japan. And I think that's probably B of J, intervention or whatever it might be. But that's what's been occurring, and it appears that that level that we hit last night, right near 119 in the dollar yen, is going to be a really interesting point. Now, those of you folks that like Fibonacci numbers, you're going to probably remember the number of 0.618, because that's where that number comes in off of the high from 6 years ago. 119.50 is the 618 retracement from that high in the yen versus the dollar. We hit 118.97 last night before we sold off 100 and some pips, which is, in a market like this, 100 pips is nothing. It's like the wind, blowing over the apple blossoms in Georgia. But frankly, it doesn't mean much until we get to that level. But we came very, very close to it last night, so it's worthy of watching it. And the reason why is the divergence between the Japanese stock market and that currency, because the Japanese stock market should be trading at 18,000, not 17. Let me see, 14,000. Yeah, 17,000. Yeah. I keep forgetting the one between the it's 14,900. I have to double check it. I know the Dow is 17,000. I think the Nikkei is 14,000. Let me double check it here. Darn it, boy, old age is not a fun thing to look at. Nope, they're both at 17,000. They're both at the same prices. You know what? Maybe the Dow is going to go to 39,000, because that's where the Nikkei was back on Christmas Eve, 1989, before it went down to 6,700, from 39,000 to 6,700 in 2002, I believe, is when it made its final bottom. So that's certainly a possibility. But anyway, the Japanese stock market should be trading around 17,800 to 18,000, based on what the currency did. So that's basically what we're watching here. So we'll see. Well, hey, listen, if the Dow can go from 32, where it was on, July the 5th of July 5th, 1932, to 17,000, where we are now, then why can't it go higher? I don't see any reason why not. There was a book out a few years ago by a guy named, I think his name was Bucky Dent, and he talked about 20,000 Dow. He's not too far off. Okay, we've got to take a little break here. Everything's good here in River City. The things that are going up keep going up, and the things that are down keep going down.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Thinkorswim, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing. Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, back to the Futures Hour.
Okay, folks, we're going to have Rich Anderson on at the break, and we're going to talk about cattle and some grains and things that I think are very important. Rich always has some really good input. But what I wanted to do was to alert you to the fact of what's happening with this Japanese currency, because it has such a high correlation with the Japanese stock market. And I posted into Tiger TV the long-term chart going back just about 21 years. And we are making a 61% retracement from the high that we made back in 1998. That's when the yen was at 147 to the dollar, and then it dropped down in half to 75, and now it's rallied back to a 61% retracement of that move. If you took a long-term view of the euro, you'll see that it also has had wild swings like this, from 160 down to 80 and then back to 140 and things like that. So they hit these numbers pretty nicely, and we have to really respect this number of 119 and change, because there's a lot of people talking about 120 as the target, and usually when they talk about that, it's either going to undershoot it or overshoot it. I don't know which it's going to do. All I know is that Fibonacci number is really powerful. You can see the other one that was there from 2006. It was making a 61% retracement. It was at 123 before dropping to 75. So we had lower tops, lower bottoms. We're still in a long-term downtrend in this. There's no question about that over the last 20 years. The question is whether this 61% retracement is going to actually hold it or not. Now, also what's interesting about this is something that reinforces your pattern recognition methodology is that if you look at the top that was made in 1997, it was making an ABCD 3-drive to a top pattern up at that 147 level. After that, we had a couple of Gartleys on the way down with the lower highs, and when it was making its bottom in 2011, it was making a 3-drive to a bottom pattern. And then in 2012, in late fall, there was a gentleman down in Clearwater, Florida. I can't remember him. I think he's a boat captain, as I recall. Hotshot O'Brien, that's his name. Yeah, Captain O'Brien, Thomas O'Brien, our fearless leader, started talking about King Dollar when the yen was at 75. Now it's at 118. So that's one heck of a move, and our hats off should be to Tom for that incredible call, because he stuck with that the whole way, and it's been one heck of a move on the way up. And this last acceleration that happened since October the 31st is really, wasn't that spectacular. It was only 5 points, which was $5,000. But I frankly don't know anybody that was short that. I know a few people that were long it. I had a few pieces of it on the way up, but it was a little too scary for me. I get nosebleeds when I'm in some of these things, and I'm more interested in protecting the money that I've made than to try to capture the last dollar. But this last move that we've had since October has been virtually uninterrupted. We've had a few 100-pip corrections just like we did last night. I was watching it last night because I was hoping that it would get up to 119.40, or I could sell it short, but we only got to 118.97. We could still make that without any trouble at all, because it's a very short distance, and all it takes is another jawboning from our friends at the BOJ, and that would give us another move to the upside. What is happening, though, is that the Japanese stock market is not proceeding the way that it did. Right after those few weeks, it stopped. 17,500 was it, and we haven't been able to break above it as of yet. That doesn't mean we're not going to, but we certainly could. Also, the stock market, we're having our third divergence between the New York Stock Exchange Index. We made a high in July. We did not take that out when we made a new high in the Dow. We did this in September. We did not make a new high in September. And so far, we have not done that. We are above the 786, however, but we've not taken out the high. So this is going to be a very interesting next few days, especially with the Bradley model hanging over our heads like this, and whether it's going to work. And like it did on October the 15th, we'll have to wait and see if that's going to be the case. So I know it looks wonderful. The VIX index, I was listening to Basil. He certainly had it pegged really well. I mean, it's starting to show signs that there are people out there that are taking protection, because with the stock market in a new high ground, this VIX should be trading at 10, not at 13 or 12.5, because of the fact that going into new high grounds usually means that there's absolutely no fear at all, but there is a little bit coming in the VIX index because it's unable to make new lows. We'll be back with Rich Anderson after the break. Got stocks up and gold struggling to hold unchanged.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped, and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With market insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 8 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com. Now, back to the Futures Hour.
Okay, we're back, and I think we have Rich Anderson on the line. Rich, are you there? I'm not getting any sound. I hope that he is. I imagine that he is.
No, I'm here.
Okay, good. Hey, Rich, someone asked if we're going to have marijuana futures. Do you have any? Have you heard about that at all?
No,
I'm not being funny, Rich, because we talked several times this morning already. But someone's asked a question about it. There was a fellow on CNBC yesterday that started a company to grow marijuana, and he raised $50 million. I mean, that they must be serious about it.
Once it becomes nationally legalized, I'm sure it'll be another good cash crop for the farmers because it's relatively easy to grow. And
how would you know that, Rich?
Well, because out in South Dakota it's a weed.
You're a weed farmer, for heaven's sakes. What would you know about marijuana?
It's a weed out in South Dakota, so it's.
Okay. Hey, Rich, I posted a chart of live cattle showing the failed pattern of the jaws of death, the T6 expanding triangle, and on that it shows that we've lost 50% of open interest in cattle, from 150,000 open interest down to 70,000 as we come in today, and prices have gone higher. You and I both know that when that happens, that means that the shorts are getting out and no new longs are coming in. So what is it going to take, and is it going to take a turn down, and what are you seeing in the cattle market right now?
Well, first of all, let's get some perspective. A few months ago, hogs were $1.33 a pound, and last month it got down to 86. That's about a 35% break from spring highs to now. That's the kind of break that we can have in the cattle, but it's not likely to happen until after we get through the winter, because unlike the hogs, which are all confinement, cattle for the most part are fed outdoors. And so the worry is during the wintertime is you have a tough snowstorm, or it becomes spring and then it gets real muddy and icy conditions, and these cattle don't gain very much. But once we get through the concern about weather, I think there's going to be some real issues where, you've got a strong dollar. So what does that strong dollar do? That's making our imports greater, and our exports of beef are much weaker. And eventually that catches up with you. We've been, the cattle on feed report comes out on Friday, and the numbers, the marketing number is going to be lower than the placement number, as it has been for the last several months. We're starting to put more and more cattle on feed. It's still small compared to the 5-year average, but eventually that'll catch up, and then you'll have the competing meats, the pork and the poultry, and it'll take its. I'd have to imagine it'll have at least a 10% correction, which will be $17. And once they get them rolling, they usually show no mercy, and it'll be probably even more than that. Not as much as the
public doesn't seem to even be fazed by high beef prices anymore. Just take it in stride with higher gasoline prices than when we had gasoline at $5 a gallon.
Right, and particularly during the holiday season, they'll be willing to spend money for expensive parties. But once you get through New Year's, I think that's when you'll start to see the high end of the beef cutout. The expensive cuts start to have real problems moving, and you won't be seeing the exports that we normally have. You'll see more imports, and that'll start to break the back of the market. The weather being the one caveat that will always keep the people nervous, because they're growing outside and they're very sensitive to the weather.
Rich, our first question is about potash. I don't know if you use potash in your operations or not, but I guess the prices have been pretty firm in potash recently. Do you have any ideas of what's going on there?
Well, we do use it. It's part of a fertilizer component. In fact, we were talking about that just yesterday in my office, and with the fuel prices having come down, and a lot of these fertilizers are indirectly derived from fuel prices, or the fuel has made it much cheaper to operate stuff. The price should have come down. Fertilizer prices and across the board should have come down a whole bunch, and they haven't. They're able to. It's kind of like the airlines. The airlines have much cheaper fuel prices, yet you don't see them lowering their ticket prices.
And all they're doing is increasing the cost of their services. Rich, we have one other question. I know you deal a lot in wheat, and one of our favorite folks from Philadelphia, Mr. Z, asked about what your outlook for wheat prices was happening, because we had a pretty good rally in wheat over the past several weeks.
Right, but you know what that rally was about. That rally was about the military activity in the Ukraine. And while there hasn't been any disruption of supply and exports to speak of, the possibility exists when you've got Russians moving tanks and artillery into a region to keep the rebels going, that it could spiral out of control, and all of a sudden some exports that you're counting on you don't get, and that's what's kept the wheat price relatively high. We have an amazing, more than adequate supply of wheat, and once they feel more secure about the Ukraine and the Black Sea origination of wheat, prices will probably go back down and visit the lows. It'll take a weather market in the spring, let's say in the spring, when the winter wheat starts to come back up. If it got real dry then, that could cause a pop, but it's fully priced at these levels from what I can see. There's no shortages on a worldwide basis. There's just concerns about possible interruptions in the exports in the Black Sea from the Ukraine.
We had a question about the weather problems that we're having in the east around upper New York and in Buffalo and places like that. I know that's not a wheat growing area or anything, but are we seeing any other weather patterns across the Midwest that we should be concerned with?
Well, we had this polar vortex, and we had relatively cold or very cold temperatures, across the whole Midwest. It has very little impact on hogs and pork because it's all combined. The cattle are outside, and they have to use so much of their energy just to stay warm that they don't gain as well. But not really. It doesn't affect the grains. The vast majority of the grain is harvested, and it's already, either in an elevator or it's in a pile someplace. The biggest problem is transportation. We have a transportation issue, and that's going to continue. And that's primarily because we're moving so much oil over rail out of the Bakken, out of North Dakota.
Do you think this pipeline would alleviate that?
It would be a huge, it would instantaneously change how the oil is transported, and it would help immensely. And the other thing is, we flame off. You see pictures of oil wells, and you see the fires, the flames. That's natural gas. Up in the Bakken, we flame off the equivalent of 2 million barrels of oil a day, from what I hear, because we haven't got the pipelines to collect that natural gas. Eventually, they'll figure out a way to either get the farmers agree to put pipelines. Right now, the farmers want too much money. It's cost prohibitive to put natural gas pipelines to collect it. There's a couple other ideas that they have, but think of all that energy that's just getting burned up every day because we haven't a way to collect it and transport it.
Yeah, I know. I remember when you and I were up in South Dakota looking at a feeding operation for the Beach Boys. We were watching some of that going on years ago, the stuff they were burning off, and I was always wondered, where that energy was going. And now with the, prices have come down so much, what happens if they go back up again? That might be something to take a look at if they could do something like that. But I frankly don't think they're going to do it because of the political implications, or you can't politicians agree on anything unless something like that.
Well, and what we're also finding out now is that there are a lot of these paid, we'll call them hitman, paid analysts like Gruber. He was a paid guy to sell us on health insurance, but there's also paid analysts to sell us on global warming.
Mm-hmm.
And, we find out, he purposely was misleading us on healthcare, and how many other people are there like that are purposely misleading us on global warming or many other things,
Okay, we've got a question about cotton, and every time I think about cotton, I remember Eli Tullis down in Memphis, and what a great guy he was. He was one of the fellows that helped train Tudor Jones. But do you have an outlook on cotton, Rich? Because I haven't traded cotton in 45 years, and I will not trade it again. So, if you have any ideas on cotton, we'd like to hear them.
Well, the net thing on cotton is that China demand is what really, it's the big dog in the world, and if you're not selling it to China, then you've got a problem. The weather is not an issue at this time of the year. I'm not an expert at all. It's relatively cheap priced, but our dollar is going up. Every time the dollar goes up, it makes all of our commodities more expensive to the rest of the world because they're going to have to buy our dollar to buy cotton, or buy our dollar to buy corn or beans or wheat. It's relatively cheap, inexpensive. This is another example of a bull market. In 2011, it was over 220, and now we're talking about a price of 58 cents a pound, and they're 500-pound bales. I would think that short of weather, the planting intentions will be in March, and then it'll be competing against beans. With bean prices at these levels, you may see the cotton acreage reduce slightly, and that would help to move it back up towards the 65 to 70 area. But, I don't see it as a sleeper giant bull market that's about to happen.
Well, Rich, if we were talking about these cattle and the fact that they're up at the 175 level, are there any options out there, like looking at an April 2015 put or something, that a strategy that could, you could put on and just sort of forget about it, risk, $1,500, and if cattle drop 17 cents, you could probably double or triple your money easily. So is there anything that you're looking out in that area? I know you do a lot of option business, and I just was curious if you followed it, and is the liquidity enough out there to do anything?
Well, options, there are so many strike prices that they don't trade every second, so you want to calculate what the theoretical value is in almost every quote program today will give you some indication of that. What I generally do when I'm I'll look at where the open interest is and where the volume is. I'll look at the bid and the offer, and I'll split the difference. But I would start accumulating some puts under the market, because if and when this thing does roll over, it can have a pretty amazing move. The volatility's in that 12-13% area. That's not real high compared to, say, stocks or soybeans, but volatility has been relatively low in the cattle market, so its volatility's been down as low as 10 and 11%. But that'd be the way to go. Just pick up some puts or some put spreads, buying a closer strike price and selling a further out one. That's the problem with spreads is, you have to wait until expiration to really capture the full amount. Or what I tend to do, particularly when I'm feeding cattle, is I'll sell calls above the market that I'm willing to take that price as a good price and then use that money to buy the puts.
Rich, we have one other question here that's probably going to put you on the spot, but I think you have a pretty good feeling for it, and that is the Fed with all these QE programs that they've been using in printing this money. Is it distorting any of the commodities markets? I mean, you'd think with that kind of money coming in that the commodities like gold and silver and copper and some of these other things would be going higher, but everything's going lower. What's your feeling?
The Fed's excess balance sheet is approximately $2.7 or $2.8 trillion. And that money's floating around, and it's mostly gone into equities. Until the CPI and the producer price index start to go in that 2.5-3%, they don't really care so much about commodities. So it's mostly gone into the equities, and that's why you see the stock market that hardly ever has a setback. I mean, it had one a month ago, but virtually it's gone straight up. That money will eventually have to come out of things, but it's going to be a while because the rest of the world is so soft. And keep in mind, this is the last Fed meeting for this board, and the members will change in January. And some of the new voting members are much more dovish and will want to keep interest rates low and be very accommodative. So the interest rate increase that everybody's been looking for might not be until 2016 of any consequence. There might be a slight increase, but won't be of any consequence until 2016, because this new membership will be much more towards leaving interest rates as low as they can. But the Fed is paying 0.25% interest on that $2.7 trillion. If they raise interest rates 1%, think how much more interest they're going to have to pay. So they got to get that money, that excess reserve down before they do it.
Hey, Rich, we got to run, buddy. Thanks for coming on, and we'll have you on in another week or so, okay?
All right, sounds good. Take care.
You bet.
Bye.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you like it does me, visit everbank.com/TFNN to find out what they can do for you. Again, that's everbank.com/TFNN. Visit them today. Everbank is a member FDIC and equal housing lender.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today. When you first learn something in life, you have the most questions as you begin to apply that knowledge, which is why Steve Rhodes came up with the idea for his 7-week trading program. It all begins Saturday, November 22nd, when Steve Rhodes will host a live 3-hour morning workshop where he'll teach his attendees the precise methodology he uses when placing trades. You'll then receive 6 weekly updates each Monday morning discussing the possible alerts currently setting up in the market. Steve will then bring everyone back together for a final 3-hour live workshop Friday, January 9th, where he'll discuss the methodology that went into each of the 6 weekly updates, making sure that you're confident in applying what you've learned so that you can begin navigating the market on your own. You can sign up right now for this entire 7-week trading program with Steve Rhodes for a one-time payment of only $395. If you're a Mastering Probability subscriber, then you can save an extra $100 off that price. For all the details, visit the front page of TFNN.com right now.
Up next, the Diagnostics Trading Hour with Daryl Martin here on TFNN. Now, back to the Futures Hour.
Okay, we're back, folks, and I believe we have our friend from Philadelphia, Mr. Z. John, are you there?
Hey, Larry, I am. Thanks for having Rich Anderson. I always enjoy listening to the two of you talk. Well,
I talk to him every day, but when we talk on the air, he seems to be more scholarly than when I chat with him. He's always got a joke or two. What can I do for you, my friend?
All right, Larry, heating oil, gasoline futures declined dramatically. I confess I did not see the extent of this decline coming. My question to you, do you see anything in the patterns that you look at that give an indication to this question? Is it close to bottoming, or is it likely to extend lower?
Well, the nearby crude, the decent Jan are setting right at the 61% retracement from 2 years ago, I believe, down around this $73 per barrel level. But frankly, we've had virtually no rally, and heating oil is really one, and also the gasoline, both. They should be, much stronger given the cold weather that we're having across the United States. Especially heating oil, it has a very strong seasonal component to it for October, November, December, and January, and it just keeps going down and down and down, which means there's just oversupply. And we have gasoline in Arizona now is around $2.70 a gallon, and most places, even places in New Jersey, are selling for $2.50 a gallon. So, prices have come down quite a bit, and that just tells us that there's, more supply or less demand. I don't know which it is, but something is there.
Yeah, nor do I. The one thing that attracts my attention, especially on the heating oil, the chart patterns are all pretty similar, but that particular futures contract has in the CFTC's commitment of traders data has given reliable signals over the past 10 years for both buys and and sells. And currently, with this big decline, what you see, or what that commitment of traders data is showing, is that speculators have gotten very lopsided on the short side, and the commercials have taken on a fairly sizable net long position. So that attracts
you want to be looking for a buy when those situations occur.
But clearly, there's no evidence of any bottom at this point. That's for sure.
Well, what Rich mentioned before is that even though we had a lot of grain out there was a problem with, getting it to the suppliers, and that caused prices to skyrocket. We had an 80-cent rally in wheat, a 50-cent rally in corn, and a $1 a bushel rally in soybeans, only because they couldn't deliver the stuff that was being harvested to the places that needed it. And if that happens in the oil market, you can imagine how quickly people will pay up for oil, especially when it gets very, very cold. So that's what you have to be afraid of. And if those commercials are on the right side of the market and they start to squeeze and shorts start to cover, this thing can really move. That's why you've got to be able to, keep an eye on what the chart patterns are saying as far as support and resistance. At least that's what my opinion is. And I think crude oil is really trying to hold here. They beat it up pretty badly over the past few weeks, but when gold was getting hit last week, crude oil held its own, and they usually have a high correlation. And so it's a question of whether we can get it back above $80 a barrel or not. And, of course, when it's trading around $75, that's a big stretch, $5 a barrel.
Very good, Larry. Thanks so much. Enjoy the rest of your time on the East Coast.
Yes, and happy holidays to you, John.
Thanks.
Okay, folks. We're going to end the show here by talking about the stock market one more time. We still haven't made new highs in the New York Stock Exchange Index. And if we do, that'll be another record-breaking event. So live every day in an attitude of gratitude, and may God bless.